Suppose this is the balance sheet of a firm on 1st April 2010, and that is capital 10,000 and cash 10,000, and total on both sides 10,000 rupees. And the following are the transactions for the year ended 31st March 2011. Purchases 5,000, sales 9,000, expenses 1,000, incomes 4,000, furniture purchased 2,000, loan taken 3,000, drawings 4,000 rupees. And prepare the cash flow statement for the year ended 31st March 2011. Before you prepare the cash flow statement, you must be having balance sheet as on 31st March 2011. If you want to have the balance sheet, you must prepare the income statement, because without knowing net income or net profit, you can't prepare the balance sheet. And you have to prepare cash book also, because you don't know the closing balance of cash. So let's prepare the cash book first. Opening balance on debit side 10,000 rupees, sales 9,000 rupees, incomes 4,000 rupees, loan taken 3,000 rupees, and total 26,000 rupees. On credit side, I am to say on payment side, purchases 5,000, expenses 1,000, furniture purchased 2,000, drawings 4,000, and by closing balance, I am to say by balance CD 14,000, total 26,000 on both sides. Now I am going to prepare income statement. So you must be aware that all transactions in this firm are cash transaction and there is no closing stock. So one thing is clear, the net profit will be equal to cash from operation. Means all the operating activities are included in the cash from operation. So let's prepare the income statement. Opening stock 0, purchases 5,000, to expenses 1,000, and on credit side by sales 9,000, by incomes received 4,000, total 13,000 rupees on both sides, and to net profit on debit side 7,000 rupees. It means this firm has made a profit of rupees 7,000. Be careful, net profit is based upon only cash transaction. There was no non-cash transaction in this firm and there is no closing stock. So I can say this net profit will be equal to cash from operation. And you know, cash from operation means cash generated from operating activities. Operating activities means purchases, sales, expenses and incomes. This is the net result of all these 4 transactions. I mean to say operating transactions. So if you want to calculate cash from operation, I mean to say net cash generated through operating activities, you can calculate. Now cash generated, sales 9,000 and incomes 4,000. So total 13,000. Please write down in the outer column in the table. Now cash lost in operation, that is purchases 5,000, expenses 1,000, total 6,000. So 13,000 minus 6,000, that is 7,000. Means this is the net cash from operating activities, or in other words, technically we can say cash from operation 7,000. And what is the value of net profit in this question? That's also 7,000. So there is no difference between net profit and cash from operation, provided all transactions are cash transactions and there is no closing stock. So let's prepare the balance sheet now. Balance sheet as on 31st March 2011. On asset side, cash 14,000, this is the closing balance, and furniture 2,000, because previously this firm didn't have any furniture. During the year, they have purchased furniture of rupees 2,000. So total 16,000 rupees. Now on liability side, capital 10,000, opening capital plus net profit 7,000 rupees minus drawings 4,000 rupees. And in the outer column, you will write down 13,000 rupees and loan 3,000. Total 16,000 rupees. So this was the balance sheet. Now we have to prepare cash flow statement. In cash flow statement, all the operating activities are not written individually. We write down only cash from operation. Cash from operation includes all the operating activities, but all investing activities and financing activities, they all are written individually. Let's see how it happens. Cash flow statement. So on left hand side, inflows, on right hand side, outflows. Inflow side, opening cash, 10,000 rupees. It's written in the balance sheet. Cash from operation, 7,000 rupees. It means cash generated from purchases, sales, expenses and incomes. Loan taken, 3,000 rupees. Because during the year, the firm has taken 3,000 cash from the bank. It was a loan. So total, 20,000 rupees. Now on outflow side, furniture purchased, 2,000 rupees. Drawings, 4,000 rupees. This is the financing activities. Closing balance, 14,000 rupees. Total, 20,000 rupees. Fresh capital and drawings. Loan taken and loan repaid. All these four things fall in the category of financing activities. So this was the cash flow statement.